Welcome to Massive Signals, where we explore the companies defining the next wave of deep tech and the inflection points that took them from lab to market. I'm David Mandel, joined by my co-founder, Ari Newman. Each episode, we go deep with founders, investors, and researchers driving breakthroughs in energy, quantum, AI, defense, and the new space economy. This is Massive Signals.
Most VCs cut their teeth in finance. Today's guest cut his teeth in engineering. Leo Polovets was the second engineer at LinkedIn, back when the company had only a dozen employees. He built early core products like LinkedIn Jobs and Groups. Later worked on fraud detection at Google, and he built data infrastructure at Factual. And somewhere in all of that, he started thinking about startups the way an engineer thinks about systems, as bundles of risk to be de-risked, not stories to be believed. In 2023, he co-founded Humba Ventures, and he used that lens to back Robinhood and Flexport early. Then in 2021, he walked away from the SaaS playbook entirely to launch Humba Ventures, a fund built around the hard physical problems that most investors avoid, things like nuclear, robotics, defense, and bio. Two oversubscribed funds later, the largest being $40 million, Humba's companies tend to graduate from seed to Series A at 3 times the industry average. And for every dollar Humba invests, it pulls in 2 or 3 more from other investors. That's the kind of leverage that makes a huge difference and something both founders and funders would kill for. Leo, welcome to Massive Signals.
Fantastic. Leo, so excited to chat with you today, and thanks for joining us. I also have to thank Julian Shapiro for the connection. And like I said in my email to you, longtime listener, first-time caller. So we're both deep tech investors, and it's been great to watch the SUSE and Humba evolution from the sidelines. So I'm looking forward to this conversation and learning more about your experience. So before we jump in, maybe I'll turn it over to you to give a quick overview and intro to set the context.
Sure. And I'm excited to be here as well. So thanks for having me on. So my background really briefly is I was a software engineer for a decade. I was one of the first hires at LinkedIn in the early 2000s, then worked at Google, and then worked at a startup called Factual for about 4 years. And then about 13 years ago, kind of by accident, pivoted to venture capital. So I co-founded a fund called Humba Ventures. That's more of a software fund. I did about 8-9 years of software investing there. And then towards the end of that period, just got more excited about deep tech. And so I started our sister fund, Humba Ventures, about 5 years ago, and have been focused on that ever since. And so we currently write checks at pre-seed and seed, usually around $750K towards upwards to $1 million. And we're very generalist, so we'll do everything from defense and energy to manufacturing and bio and space and kind of you name it. We're just very open-minded deep tech investors.
So, Leo, you said something there kind of in passing, but I want to dig a little deeper on it. So you said by accident, I became a VC. Like there's a lot hidden underneath that by accident. I'd love to learn a little bit more. Like what was the how did that actually happen? Right?
So the story is, so I was pretty lucky. I joined LinkedIn when it was about a dozen people right out of college and worked there for a few years. Then worked at the other startup I worked at, Factual, was also about a dozen people when I joined. I worked there for 4 years. And so I had this kind of, seed plus to Series B experience a few times. And I'd been working as an engineer for about 10 years at that point. After I left Factual, I had some startup ideas I wanted to try out, but I also felt like I'd never seen what inception stage looked like. And I wanted to learn more about that. And I had a few friends that were angel investing, and they wanted a technical person on the team to help them with tech due diligence. And so, and they invited me to join. I thought this will be great. I'll see how investors think. I'll learn about kind of more inception stage startups for a few months. And then maybe in 6 months, 9 months, a year, after I've learned a lot and like kind of built out my network a little bit, I'll go start a company. And instead just like really fell in love with investing quickly. And so after about 6-7 months, this angel group, we started talking together about, hey, should we start a fund here? Because we're working together. We like the companies we see. We like the investments we make. And so we ended up actually just starting Humba Ventures out of that group about 13, 14 years ago now.
Cool. So quick follow-up, because you keep saying some interesting things and I want to go deeper on. So you said you wanted to get a view into like how investors think. Right. So once you got that view where you're like, oh, this is how I think this is great, or these guys have it all wrong, I can do it better. Like where was your mindset when you really got in and saw how the sausage was made on the investment side?
That's a great question. Honestly, a little bit of both. Because I would say it was definitely mind expanding at first to like compare notes with my partners and other VCs I'd met at the time. Specifically coming from an engineering background, I really over-focused on product and engineering. And so in that first, 3-6 months, a lot of times I come back to the team and be like, oh, this is an amazing engineer. They have this great algorithm. Like I love the tech. And then, my partners or some other experienced investor look at it and be like, yeah, but the market's like really crowded, or they're pricing it terribly, or like no one's going to pay for this because it's low priority. It really like, kind of inculcated into me that like, hey, I should be looking more holistically at these businesses. And, I need to look at the moat and the business model and the team, like, and then not just the technology. So I think that was a good lesson. And I didn't know how to evaluate a lot of that stuff early on. And so I think, a lot of learning in that first couple of years, and I really enjoyed it. But there are also like, some of how the sausage is made. I thought there were some things that just felt wrong to me. Maybe one specifically that I've posted about a few times is I think pass emails tend to be like, a lot of times investors will either ghost or they won't share like, why they're passing. They'll just say like, sorry, it's too early. And when I first heard about this, it felt weird to me because, investors were saying like, oh, you should like not tell the founder what you really think because you want to keep the option value to invest later. And I was like, well, at that point I was like, I think I want to be a founder at some point. If I pitch someone for like 3 or 4 meetings and spend a bunch of time on them, and then at the end, they just said, sorry, it's too early, I'd be pretty frustrated that there's no feedback. And so I tried sending people feedback and the response was really good. And so, I started just like sending feedback to everyone after they did at least one pitch meeting together. And I think like that's worked out well, but there have been things like that where, I see how the industry does something and a lot of it makes sense. And some of it like maybe from first principles doesn't make as much sense to me. So I try to do it differently.
Yeah. I think we had a lot of the same insights when we were building Massive.
Yeah. I think when David and I were getting started, we spent like, I don't know, so many hours kind of putting everything on the table of like, what do we love and hate about venture? What do we love and hate about being on the operator side, being on the investor side? And just we're sort of convinced there was another way to take a crack at this. So, yeah, your career has, been incredible. Like LinkedIn at 12 people, Google, Factual, like you seem to have found a way to get in on the ground floor at some pretty epic companies. And then starting your own firm and then building Humba. Like, is that a pattern that you seek out? Like you want to get in early and you'll go take the risk around those opportunities? Or has that just sort of been what happened? Like, has it been flow or deliberate?
I think it's been a little bit of both. I would say it's more like if I think it's kind of a unique opportunity, I tend to try it out just to see what happens. Well, with LinkedIn, actually, like, the reason I got lucky is I had an internship in college at the same company for 3 years. This was during the .com bubble imploding. Mm-hmm. Nobody was really hiring. So I just worked for a company that eventually got acquired by Reuters, like the media firm. So I essentially had an internship at Reuters for 3 years. The engineering team there was okay, but there was one guy that really stood out and he became sort of like a friend and mentor to me. And he ended up being a co-founder of LinkedIn. So he pulled me in really early. So it was just a luck thing. And, I wasn't sure. I didn't know anything about startups or social networking, which was just starting out at the time. But I knew I really liked working with this guy and I thought I'd learn a lot. And I think that materialized well. And then with Google, I was happy at LinkedIn, but I had a bunch of friends that had gone to Google and said like, hey, you'll really love it here. And so I just kind of thought like, well, I like LinkedIn. Let me interview at Google. If I don't get in, I'll stay at LinkedIn. And if I do, like, I'll think about it. And they gave me an offer and I decided to take it. But again, it was more of like, oh, it seems like an interesting opportunity. Google had just gone public. I enjoyed LinkedIn a lot, but also felt like, maybe something new would also be fun. And then when the venture thing came up, that was, again, this example of a pretty unique opportunity. Like I didn't think anybody would ever invite me to join their angel group. I hadn't really thought about investing as a career. And I certainly hadn't thought about like venture as a career. And so I sort of felt like, well, if I say no now, I'll probably never get the shot again. And if I say yes and it doesn't work out in a year or two, I'll just go start a company or join a company. So I just felt like a lot of these things were, interesting and high upside and then pretty good fallback if it doesn't work out. And so that's been kind of my philosophy on a lot of these things.
Yeah. I like the whole interesting upside mentality, right? Like this.
It's a venture mentality, right? It just sort of innate to nature, but like I've kind of had it for my career for a lot of the time.
Yeah. And so, sometimes it's hard to explain that mentality to like family members who have traditional like careers and other people. But I think like it's the right way to think about it. Like this is going to be interesting and challenging, right? And I'm going to learn. Yeah. And like, doing deep tech, we feel like we learn every day. I'm sure you feel the same. Like we get into rooms with founders doing crazy stuff that's going to change the world with unbelievable technology that we have to like spend hours understanding. It's just so exciting and learning every day. But so let's talk about that. So you've made the transition into SUSE and you're obviously having good success there. But then you decided, no, I want to do something different. Right. So, SUSE's doing a good job, Robinhood, Flexport, right? Good playbook, making good traction. And, then you transition to deep tech and Humba. Like what made you want to do that? What was that kind of key inflection point for you mentally?
I would say I think the big thing is that I've always liked technical stuff. like I was an engineer. I went to Caltech for undergrad. Before that, I was doing math and science contests in high school. So I always liked kind of the math, science, technical side of the world. And I think venture in general really scratches that itch. But I think on the software side, a lot of times actually the challenges are not technical, right? And that, especially as time goes on, especially today with AI coding tools, it's less of a question of like, can you build it? Or how do you build it? It's more a question of like, are you building the right thing? Do you know how to sell it? Like, can you assemble the right team? And I think those are interesting questions to me. The tech stuff was really pulling at me. And like, I kind of wish there was a little bit more, deep tech, no pun intended, in the kind of investments I was making. And I looked at that, I looked at the deep tech category a little bit from time to time in my first, 5-6 years at SUSE. So the first angel investment I ever made was a robotics company because like it didn't fit SUSE, but I really liked it. And I was like, let me throw in a small check and see what happens, right? So I've always, kind of kept an eye out at those spaces. And I think my main lesson, kind of in the early mid 2010s was it was just really hard to invest in these areas. And there are basically like three reasons I saw. One, the upfront capital needs were usually a lot higher because you just needed a lot more to do robotics than, build like an app or something. And then the follow-on capital was a lot worse. So there were maybe 5 or 10 funds like Coastline and Recent and Founders Fund that did Series A's here. And if you couldn't raise from them, you just ran out of money because there's just so many at-bats you get before all the other funds are like, well, we just don't invest in hardware. And the third one is I think the talent was pretty good, but a lot of times didn't have a lot of startup experience or, more academic. And like, I think that's a decent profile, but maybe not the profile that a founder like I work with best. And so that's kind of what I saw maybe 2013, 15, 17. When I looked around again in 2020, I felt like all of these things had changed. Mm-hmm. And so the cost to start hardware companies kept dropping because sensors and robot arms and gene sequencing and all this stuff got cheaper and cheaper. And on the flip side, like software rounds started inflating. So they went from, 1 million to 3 million to 5 million. Crazy. And now you could actually do a lot with a $5 million round for a hardware company versus like you couldn't do a lot with a $2 million round for a hardware company 5 years prior. And then because of, SpaceX and Tesla and Palantir and like, Anduril 5 years ago, a bunch of later stage investors were suddenly thinking like, hey, we should get in, to the next set of companies at Series A and B. So that market got a lot better. And then the talent from those companies, the early employees from those companies started spinning out and either joining or starting startups. So I felt like the caliber of founder got a lot better really quickly too. And so it just felt like a much better time to invest around like 2020, 2021. So I started chatting with the team about it. It kind of felt it would make sense to maybe do this with, a smaller check size to start as we were exploring the area. So SUSE was writing $2-3 million checks, but we didn't want to go in guns blazing. We wanted to start with like bigger portfolio, kind of more mid-sized checks. The team composition felt like it would be different because maybe we should hire, less software investors that have one skill set and maybe more investors with a different skill set. So after talking to the team, basically decided to set this up as a small pilot fund where I would run it for a couple of years. We'd see how it goes. And then if it went well, like, I'd grow more of a team around it, fundraise around it. But we'd share all the like operational infrastructure that we have. So we share a physical office in SF. We share an operations team that's really great. We share the back office, accounting software and things like that. So basically like share all the non-investing stuff and the investing teams do their own thing. And it's worked out pretty well so far.
Leo, did you carve out capital from the SUSE platform for Humba Fund 1, or did you go raise from either existing or new LPs?
The first fund was both, but it was like a quick, easy fundraise because it was a $15 million fund. So it wasn't that big, relatively speaking. And SUSE at the time was about 125. And so we pulled half of that $15 million fund out of SUSE. So $7.5 million. And then we had one LP we'd worked with called Sundana. That's a great seed fund of funds that wanted to kind of get in with us on the ground floor. So they'd matched the 7.5 with their 7.5. And that was the whole first fund. We raised the second fund about 2.5 years ago. And that was just a straight fundraise with no SUSE capital in the fund.
And at that point, you had some track record. So you didn't run into the thing where your SaaS LPs were looking at you and asking you questions about how you were going to be a deep tech investor. You had already had some tape on it.
But yes and no, in that I think that was actually one of the most common questions, right? It's like, I'm a software investor. I'm shifting to deep tech. Does that picking skill translate or not translate? So when people passed in fund 2, that was one of the two biggest reasons. The other one being, I think three-ish years ago, it was still unclear to a lot of LPs if deep tech was a good category. I think that the thinking's really shifted around that in the last few years. But that was a big question of how does the picking translate? And then there was starting to be a track record in fund 1, but it was a 2-year deployment period. So there wasn't a lot of track record. It was more like, well, there's a couple of Series A's and the investors look good. There's no money returned yet. And on paper, it's still pretty small. But now over the last couple of years, that fund's matured quite nicely.
Yeah. So let's keep going on that for a second. So what do you think are the big differences? Or let's be specific. What do you think the big mistakes are that investors make that are traditionally SaaS investors that are all trying to get into deep tech now? Because it's like the big hot thing, right? And they're all trying to figure out how to like transition their underwriting, their fund model, their approach to switching from SaaS to deep tech. So what do you think are like the big challenges and the big differences or big mistakes investors make specifically when they're trying to shift that mindset?
Well, I'd say like the biggest one is like the technology and idea are a lot more important, because in software you have these very successful pivots, and I think it's because a team that can sell CRM software can also sell software to some other industry or make an app. It's kind of the same skill set for a lot of things, and that's why you get these famous pivots like Slack started as a video game, right? Or I think YouTube started as a dating site. The people that could build a dating site could also build a video app a lot of the time. On the deep tech side, it's much more skill dependent, right? So you can't start with a nuclear reactor and pivot into robotics or pivot into satellites. It's just very different technologies, skill sets, people. So I think on software, it's easier to just be like, oh, this founder is awesome. Even if I'm not sure about this idea, like I'll just bet on the founder. I think here you have to really bet more on the idea and the technology and like what else is out there and is this the right approach? So I think that's probably the biggest place where people get stuck sometimes. The other one is just the milestones are very different. So on the SaaS side, on the software side, you often have traction pretty early on if it's working. And, one, that's the thing people often grade as you continue for future rounds. Two is sometimes you don't need future rounds because maybe you make enough money where you could bootstrap a small team or a growing team. On the deep tech side, you usually can't bootstrap for, the first few rounds because things get expensive with hardware, especially as you start scaling up and manufacturing and needing a bigger team. And so a lot of the Series A's and often Series B's are based more on like, how good is your team that you've hired? What are your technical milestones? Like maybe you have some pilots or, kind of early customer feedback, but it's not revenue based. So I think when you're doing a seed in one of these companies, you're not underwriting to what kind of traction can they get. It's more like you're trying to underwrite what kind of progress can they make on the technical and team side. And then you have to have a good sense of what would be considered good progress here. Like what I think would get the next set of investors excited versus just a pure traction bet.
Yeah. Well, I think there's a great transition point to talk a little bit more about these inflection points. And as we talked about before, massive. We're big on investing at key commercial inflection points. And in deep tech, as you were just saying, like revenue is often the lagging indicator, not the leading indicator. And the milestones and proof points are what come first. So, one question sort of meta is, as you started down this journey investing in super early deep tech companies with Humba, like, did you have an inflection point at the firm level where you felt like, okay, this is going to work? Or did you have one or two portfolio companies that validated the whole thesis? Or were there a couple of years there where like you've placed your bets, the companies are in R&D mode and you're just waiting to see what happens? Curious what the Humba inflection point was where you really started to build some confidence.
I don't think it was a step function, right? Where I was not confident and then something happened and then like it felt good. But I think over, probably in the 1 to 2.5 year mark when we started getting follow-on capital, or sometimes when we'd invest in a round, we'd make our own decision. And then later some other like kind of peer fund that we respected would come in. I think that gave us a lot of, just like near-term validation that we were doing something that like, I don't know if we were amazing, but we weren't stupid, right? Because it's sort of like, we backed this company and then Founders Fund did it, or, the next round, or we backed this company and then someone, 50 years or data collector, like an older deep tech fund that we respect came in with us. But independently, we didn't invest because they were in, we invested and then found out they're in. And so I think that was good early validation because early on, that's especially for these companies, it's kind of the most you can hope for. And then I'd say it's starting more 2, 3, 4 years in, and we're about 5 years in now. That's when we started companies actually get to pretty significant traction, where sometimes it's government contracts that start at hundreds of thousands of low millions. But, for example, like our portfolio company, Northwood Space, they're 2 years old or 2.5 years old, but 2 years in, they signed like a $50 million government contract. We're like, oh, that's pretty legit. Or we have other companies where, they kind of go from like prototype to like, mature prototype to pilots and then to contracts. And then sometimes you see people paying millions of dollars just for the pilots. And you're like, oh, well, that's serious because that's an amount of money that people wouldn't pay trivial or like companies wouldn't pay trivially. So I think those are the kinds of things that keep boosting our confidence over time. But, being in venture for almost 15 years now, well aware that a lot of times the early signals are directionally interesting, right? But like, I think what really matters, where do things end up in year 8 or 10? And so I think we're still waiting for that, but we feel good about our
you never know what happens 10 years in, right? until you get there.
Yeah.
What, the other thing in deep tech, hard science companies is there's a lot of single customer risk. And, like that contract, the $50 million contract, well, that could be for a project. That project could run for 2 or 3 years. There's a bunch of deliverables. Revenue moves up substantially. Post-money valuation moves up because you got to deliver against those contracts. And the company's only as good as the next contract it signs. So how do you think about that, especially as these companies are making these step function jumps in valuation and traction? But they're, like when we would go evaluate a software company, obviously customer concentration risk was always a red flag in diligence. And you look in deep tech, and a lot of times in the early days, it's actually a huge validator that there's product market fit, but you are totally buying into like single customer risk at a severe level. So how do you guys think about that?
I do think it depends industry by industry. Well, even on the government side, for example, a lot of times there's many, many departments and programs that could use the same product. For example, I work with this company, Dante, that does, they do geospatial search and geospatial imagery search and analysis, both for government and commercial applications, but mostly government. And so you can imagine you have some satellite data, you want to see like, hey, is there troop movement in Ukraine or Iran or something that I should be aware of, or like alert me if something happens. But it's interesting, like every branch of the military, but also interesting to like the Department of Agriculture, because they want to like see what's going on farms, or if there's like flooding somewhere or something. A lot of times there's a lot of different buyers, even if there's like one big buyer, like the government. So, I think we do look at that to try to get a sense of like, is this really generalizable, whether it's within a buyer like the government or across buyers, or is it really like you're going to have one program and that's going to be it, and if you ever lose it, like you're really screwed. So we do think about that, but most of the time that's not too much of a risk. I think it sometimes lowers valuations a little bit, right? Because, a software company with 10 million ARR from 100 customers that pay 100K, that looks very diversified. If you have 10 million, but it's one customer, it's still very meaningful, but maybe you get a little bit of lower revenue multiple because there's some risk there. But I think overall, like I think what we really care about is like, can this be huge in 10 years? And so the short-term stuff is a little bit less important than that on a time scale.
Yeah. The do-use stuff can really be challenging, right? Like we look at a lot of dual-use technology companies, and you invest a lot earlier than we do, so we underwrite in a specific way. But like, I'm curious, how do you counsel your early dual-use companies when they're getting strat buys, TAC buys, there's DIU grants, right? Like non-dilutive funding, but it's not like real customer revenue.
Yeah,
right. We all the time we see pitches from those types of companies like, oh, look at all the revenue you have. I'm like, it's not really revenue. It's not doing funding, which is great, but it's hard to underwrite that to a commercial inflection point for us. So like, how do you counsel those companies when they're going through that, they're getting that money and they're excited as they should be, but like, they need to raise another round. So do you find that that's an interesting conversation?
Yeah, I think, a lot of times it's sort of, the founder has their own point of view, or it sort of matures organically as things go on. But what I've usually seen is a lot of times things like SBIRs and some of these like early government grants they're good to fund research and development. And that's what companies often end up using them for, is basically like to supplement whatever venture funding they have. And either do more or make their current money go a bit further. But in the long run, whether it's for commercial or government purposes, like you need customer validation, like real validation. And so you use these kind of interim smaller grants and contracts to either get to a large contract with a real government buyer that's more, substantial, or to like, build out software that the government's interested in, but maybe like there's more commercial pull. So you're like selling more to like, B2B or something like that for a while.
Yeah. It's always a hard conversation with it because they're getting very excited, obviously, that they get the funding as they should. Right. But it's not really market traction.
Yeah, I definitely don't view it as like, hey, you have $10 million of SBIRs, so like, what's the revenue multiple on that? Because it's not revenue.
Right, exactly.
It's almost like pilots, right? Where it's like, you don't assign like a revenue multiple to pilots in the same way you do to contracts, but it is like an interesting sign of, hey, there's general interest in this. Sometimes the interest is from one, back to customer risk. Sometimes it's like you have one big, SBIR or something, or one big contract, a pilot, but it's with one department. Sometimes you have 4 medium ones with 4 departments. And you're like, oh, that's interesting. It seems like a bunch of different people and different organizations want this. And again, it's not the same as true revenue, but it's a good kind of leading indicator of future demand.
It's interesting. This is really interesting, right? The way that I sometimes think about non-dilutive funding and everything from DARPA to DIU and SBIR is like at the earliest stages, sometimes, not always, sometimes the government is paying a bunch of other really smart people to be an extension of their lab or their R&D. The RFP or the thesis is asking a question: is this thing possible? We need somebody to go figure out if this thing can be done cost effectively. It may never have a commercial future, or it might. It depends on what's going on. Looking at what InQtel is doing is always an interesting piece of data in that vector as well. And sometimes you're getting the answer to those technical questions, but the market question isn't quite clear. And, I think in the software world, it's easy to say market risk can kill a software company. Like, you can build a great piece of software, but if the demand or the use case isn't there at scale, it's not going to happen. Technical risk can kill hardware or deep tech companies, because if you think you're going to build something that's never been done before, but it turns out you actually can't until you try to manufacture, like building something on a bench in a lab is one thing, but can you build it at margin at scale is a different question entirely. So, when you're evaluating companies, pre-seed, idea, stealth stage, and you look out at that 10-year lens and you're like, this could be absolutely huge in 10 years if it works. How much back testing do you do about the technical risk, or are you really underwriting the team's ability to figure it out?
I would say it's both. I don't know if that's cheating, but we do try to understand the technology as well as we can, and obviously there's limits where, like, if it's some advanced form of fusion, I can read about it all I want for a week, but realistically, I'm not going to understand it anywhere near what an expert would. In those cases, we probably lean a bit more on experts. But if somebody just generally has a technology approach, we try to understand, how does it work? What are some of the alternative approaches? What are the pros and cons at a high level? Because especially over that 10-year horizon, it might be like, hey, this is better today, but it turns out there's this even better thing around the corner that people are trying to get to a point where it's usable commercially. So we do look a lot at the technological landscape. And then related to the team, we do want to feel whatever this technology and company needs fundamentally, right? Maybe it's you need awesome mechanical engineers and electrical engineers, and you have to really know pharma sales or something. We want to kind of see that ability on the team. Ideally the founders, if not in the founding team, if not then advisors. But it's hard for us if you're hey, we have this awesome technology, we're going to sell it to the Defense Department. None of us have any defense experience. We've never talked to the Defense Department, but we think they'll want it. That's a little bit harder. But we sort of want to see this pairing of interesting technology that feels meaningfully better than what's out there, what's around the corner, and then a team that's well equipped to productize it, commercialize it.
So so team and market fit is really important for you.
Yeah.
And one of the you touched on this earlier, but one of the things that we've certainly run into in the LP market is if you're a VC deep tech generalist, there's a lot of the investor class that will say that's impossible. You need to be the domain expert and be able to underwrite the technology. How can you possibly know which approach at some advanced reactor is going to work or not work? What's your edge around that? How do you guys overcome that?
I would say the biggest edge in most areas is frankly, everyone's on the same footing, right? If you're oh, we have this new chemical process that treats cotton in a certain way. It's not there's a bunch of VCs that are oh, I'm a cotton treatment specialist. This is my jam. And they're I'm going to, out diligence everyone. More all the deep tech investors are oh, it sounds interesting. I've seen some stuff with enzymes before. Maybe I've seen a textile company or two, but it's not you're competing with a bunch of people that know 100x more than you. So you're just trying to assess it the best you can. And then all of us have these different frameworks of I value the founder more. I value the idea more, or I have a good network here, so I can try to diligence with customers if they'd want this. And so I think each fund will look at the same company and have a different conclusion. But, it's not, we're really outflanked on most areas. And on the popular areas, let's say it's robotics or space, we're probably a little bit outflanked by the specialist funds. So what we actually try to do is one, we do the best we can, right? So, can we get to 80% of the quality of diligence where we could still directionally be right or wrong, at the similar consistency level as them. But then we'll also loop in those specialists, because I think one, it helps us to, see how other people think. And then two is I think it's best for the founders if they have both some generalists and some specialists at the table. And so I think that's worked out well so far. And I will say, I don't know that we've had any companies I can think of where like we did tech due diligence and we made an investment and later we're like, wow, we were really dumb and any robotics or chemistry expert would have passed on this. I think usually things fail because like, well, we thought it would be hard and it was hard. It was harder than we thought or more capital intensive than we thought or like, we just couldn't find the right like person to do this critical piece. And it's tended to be more that kind of stuff versus us failing to assess the technology reasonably well.
Have you seen any of those, like when you've made good assessments, there's a big difference in our mind between hacking and scaling, right? And getting something out and getting some early traction versus actually scaling a company. And a lot of it is based on like first principles, early design decisions, early technical decisions. Have you worked with any of your portfolio companies that have like gotten early market traction and all of a sudden realized like, oh my God, we have to change the entire foundation of the technology to actually scale this thing?
It's usually not that substantial, but a lot of things do change meaningfully for scaling. And I would actually say this is maybe one of the other differences with software, where maybe like 13, 14 years ago when I started, sometimes, if somebody's building a consumer app, you'd ask, well, how do you scale this to 1 million users or 20 million users in terms of technology? Because back then it wasn't trivial. But I think at this point, it's like nobody asks, how do you scale this to, 1 million customers? It's just so many companies have done it. You're pretty sure, future software companies can do it pretty straightforwardly. On the deep tech side, it's pretty different. Because if you're making hardware, a lot of times the prototype is one way, but maybe you need to change some things to make it mass manufacturable. Or if you're doing something with, let's say, like enzymes or chemistry, maybe it works in like a test tube, but not in a 10-liter tank or a 1,000-liter tank, because the physics and the kind of the fluid like dynamics change in those kinds of environments. So a lot of times that scale up risk is a very important one to assess as an investor, but it's also very important for the founder, right? Because you don't want to end up with, hey, this thing worked in a lab and then we just never got it working in production. So I think for us, mostly it's just talking to the founder through that early on and trying to understand, do they see the risks? Are they dismissive of them? Have they thought about them? Do they have, good answers, even if they're first principles or simulations or something of, how they would approach going from like, the current scale to production or production to 1000x, because those are more meaty questions, I think, on the deep tech side than the software side.
Yeah, absolutely.
Yeah. Well, everything takes what? I mean, it's sort of like remodeling a house, twice as long and twice as much, or maybe there's a higher factor there. So, Leo, you wrote, I think it was a year ago or so, a piece about explore and exploit. And I think that was really like a computer science centric idea about gathering information, using it, and executing based on the information you have at the time. Does that translate into deep tech? Do you still use that framework?
I'd say probably mostly on the go-to-market side.
Mm-hmm.
Because a lot of times, you're kind of constrained on the product, right? There's only so many ways you could build a robot arm or something, right? You're probably not testing like, should I make it out of titanium or metal or plastic? You're probably just, I have a design, I'm going to make it. But there's a lot of explore, exploit you could do on the market, right? Because we built this robot arm, but like, what's the right initial customer to deploy it? And maybe it's based on like what the special features of your robot arm are and like what it can do that others can't, right? But like, should you go into, food packaging or, chemical automation or like there's all these things. And sometimes people will do a good job of the exploring piece and then they like pick the most promising area. A lot of times we see people like pick an area that they know well. And it's like, maybe that works and maybe it doesn't, right? Maybe you should have checked some other areas that would have been even better. So I think that's like the main thing we look at. We use that lens on the deep tech side.
Got it. Yeah, I think you get to a place and, both the reversibility and the iterative, like you can't completely reinvent the wheel every couple of months. Like maybe if you're in additive manufacturing, you can mess around with different materials, right? And run through sort of an experiment process. But
I do think that's a great example of the difference between like SaaS software and deep tech, right? Like that's very much the perfect mindset early on in SaaS. You can test easily, you can test hard, you can it's reversible, but like, if you're building a quantum solution or something like that, like there's only so many different directions you can go in to actually test. So I think that's a good example of one of those real challenges.
Yeah, absolutely. And I think on the hard, like the more physical side too, there's only so much testing you can do because the hardware iteration cycles are much longer. Yeah. And so what you said about software is like very true, especially now. You can go, code and launch a prototype a day now.
Yeah,
right?
Easily.
But on the hardware side, it takes like 3 weeks to go build something, maybe 3 months or, half a year. Yeah. You can't just be like, oh, let me build like 5 things for half a year and see what works. Like, well, you run out of time, right?
Yeah.
So you can test the go-to-market a bit more, right? Maybe even while you're building, but like the physical stuff's a bit harder to, let me try 50 things and like pick the best one.
So I think that's where a lot of early investors get in trouble too, right? Because you don't know what the capital stack you need to kind of move from that early testing. So,
yeah.
But I mean, that's a great conversation to have, right? So we all understand the SaaS world. I'm sure most people listening to this, that playbook's pretty straightforward. When it comes to deep tech and reindustrialization and infrastructure, this theme we keep coming back to, that there's this gestation cycle. You're in the lab, you're researching an idea, you're trying to prove that it can be real. Then you've got to figure out how to make it for the customer. The financing stack, how you finance the company, the capital and cap table management needs to be a little bit different. So there's so many, I think in this realm, there's obviously the grants, the government grants that we spoke about earlier. There's equipment financing. There's project financing if you're building a production facility, or a manufacturing facility. There's matching funds like, Sibur Phase 2 matches with venture that comes in. This is very different than like your traditional, sort of software evolution. Do you think, is this something that you look to understand with your portfolio companies to make sure the founders are building their capital stack using all of these tools? Or do you help them with that, or do you not care?
We definitely, when we think it's appropriate, we try to help them understand if they're not thinking about it. And then we definitely try to help if they're thinking about it. I mean, I would say like not automatically, right? Because some businesses like one thing I would say is like, I think deep tech's a spectrum, right? So, you're building like a nuclear power plant, clearly deep tech. What if you're like, hey, we buy an off the shelf camera, we modify it for like, in a tiny way. And then we like, capture some data and do like machine learning on the data. Like kind of deep tech, right? Because you're doing something with hardware, but like just barely, right? Mm-hmm. And so I think for a lot of those companies, maybe like you're doing something mostly off the shelf and it's cheap. Like the nuclear power plant's like tens of millions of dollars or millions of dollars. That camera might be like $300. Like you could buy, 100 of them and like it won't break your bank account. So I think it's not like an automatic red flag if someone's not thinking about financing, because we do have companies where they have enough revenue for their product or their product's cheap enough to make that like it's just not an issue. But that said, for the big ones, like it's not that it's a red flag. It's more like it's a real missed opportunity if you're not thinking about the non-dilutive side, because like the disadvantage of deep tech versus software is like you get to revenue slower. And so, one, it means that like you're more dependent on venture funding generally. And two, is it like kind of really, you can't bootstrap. On the software side, like you want to hit whatever, 2 million ARR for your Series A. But if you hit 700K, you can't raise a Series A, but that might be enough to go sustain your team of like 5, right? And then as your revenue grows, you get to 6 and 7. And like you can kind of bootstrap it. You can't do that with hardware. So that's like the disadvantage of the hardware side or the deep tech side. The advantage is you do get all this non-dilutive financing, right? And so you could be a pre-seed company and get $1 million loan to buy, $1 million piece of equipment, because the lender's not underwriting your pre-seed company. They're just looking at the equipment and they're like, well, if you got a business, I can go resell it for $950K. That feels pretty safe. I'll give you like a good loan for it. So I think not using that stuff is, it's just sort of like you're missing out, right? Because maybe you raised $7 million and gave up 30% of your company, and it could have been $5 million for, 20%, because you could have got 2 in debt. And that applies at seed round, applies at Series A, it applies at Series B. So it's just a tool that people should be using a lot of the time for like the more expensive, deep tech projects.
Have you ever seen any of your companies kind of over-optimize for government-based non-dilutive funding and miss the commercial opportunity because they're too focused on the government interest? Or is...
I don't know if I've seen that, but I've seen kind of an adjacent flavor of that, which is you spend so much time chasing like SBIRs and grants that you just, you're like, oh, like we booked another $500,000, we got another partner. But like what really matters is like you want to get those long-term contracts and you want to like focus on them at some point and make sure like, is there real interest here? Or is it just a lot of pilots? And like, frankly, we saw this on the software side too, where, we've had companies we worked in the past where, they have like 20 pilots and then, their next quarterly update's like, hey, this is great. We're up to like 30 and then 40. And it's like beyond like 20, like you don't need to prove you get more pilots. Like we could see you can do it. Like, can you convert 1 or 2 of those to contracts? Right. And if you can't, then it doesn't matter how many pilots you get. And sometimes you see a version of that on the cyber government side where people just kind of chase grants versus trying to build like a bigger, more repeatable business.
One of the things, so what you just articulated reminds me a little bit also like hardware and deep tech companies, they take longer to get going a little bit, but that difficulty also builds moat out of the gate. And as you mentioned earlier, like especially now, these days, you can basically steal a B2B website and vibe code it in a weekend and have something that's like a 80% or 50% as good version of it. Mm-hmm. But if you've been innovating, let's say a hyper advanced, battery or motor technology based on novel materials, and it took you 4 years to figure out how to wound the motor, to run a kilowatt through it, that's moat. And as you said earlier, like it might take someone else a couple of years to catch up. There's patent, there's regulatory, there's customer demand, there's all of these things that sort of come into it. So do you have portfolio companies that are like still in the moat building phase and that they're there? And have you seen companies successfully go, we built the moat, now we're executing against that advantage and have that sort of inflection point happen?
Frankly, like most of our companies are probably still in that product development moat building phase just because the portfolio is still like 4 or 5 years old on the older side. But I 100% agree with you. Like, I think the barrier to entry and the difficulty is like a big part of the moat here. And one way we think about it is like, for some of these businesses, even with unlimited capital, like you just can't do it faster than a few years. Like one example is like we have a portfolio company, Antares, that builds nuclear reactors for defense and space applications. And they just had a big milestone last month or a couple of weeks ago where their reactor went critical. It was like the first new design that had done that for like 40, 50 years. And it basically means that they showed they could like start a nuclear reaction and sustain it.
Yeah.
And it took them about 3 years to get here, which is like really fast. And I think they've raised something like 150 million to this point. But there are companies that have raised, 500 million, $1 billion or more, and like they're not moving any faster. And I think it's because like there's only so much you could compress this, right? Like you need to hire a team, you need to build a bunch of subsystems, you need to figure out like the sourcing and the manufacturing. But then there's also like, the safety reviews and the government approvals, and like you can't condense that into a month, even if you had like $10 billion. And so I think for a lot of these companies, that becomes like in the first couple of years, it's like a huge drag, right? Because you're like, it's going to take us a bunch of money and time just to go build the first version. But after you build it, especially if you don't have a lot of competition early on, when you launch, it's the opposite. It's like this big moat where everyone else is going to take 2 or 3 years to catch up if they start today or maybe longer. But in the meantime, like you're working on your V2, you're selling your V1, you're building a track record of like safety or, reliability or things like that. You're locking in customers that aren't going to switch in a couple of years. And so I think that that part that was hard in the beginning becomes like the competitive advantage as once you're actually live. And we have a bunch of companies sort of, approaching that going live phase, which we're pretty excited about.
But, that's really interesting pattern recognition around deep tech. Obviously, that's super different than traditional SaaS and software investing. And there's like so many new investors. Now the deep tech's a thing, right? Like all the new allocators that are coming out there, they're all looking for deep tech exposure. They're trying to look for interesting managers and funds in this space, but a lot of them don't understand how deep tech works, right? Has it been difficult for you to have those conversations with LPs, like when they're used to, markups 3 to 5 years in, right? And understanding where the fund they invested in is getting marked up, yet you're explaining to them, it's like, no, like this is going to take a while, right? With some of them, like, are you finding that as a difficult conversation, or are people just like, we get it, we've been doing the research, or like those are going to be interesting LP conversations?
Yeah, like it's a really fun topic to chat about and like close to my heart. So I enjoy the chats. Mm-hmm. There's definitely like misconceptions and I think myths about the deep tech side and sometimes misunderstandings. And so we tried our best to like explain them. And actually some of the blog posts you mentioned over the last few years were basically things I wrote for the public, but they were often driven by LP conversations. Mm-hmm. So like a few years ago when we were raising, one of the biggest questions was like, well, is deep tech more capital intensive? Is the time to exit a lot longer? And I didn't think it was, but I wasn't sure. And so I looked at a bunch of data on PitchBook and tried to analyze it. And what I saw was basically it was kind of similarly capital intensive and time intensive to software. It's just kind of a different shape where it's more capital up front, but then less later because the growth is a lot cheaper than on the software side. You don't have to pay a ton for like sales and marketing, for like a nuclear reactor versus like trying to get, 100 million of sales of like a software product. So the shape is different, but I think the overall numbers kind of look the same. But it has been like, like I read these blog posts. I try to like kind of think about like what's the best way to present this and explain how it's different. Because we definitely get a lot of questions that I think frankly like apply well to the software side, but not the hardware side. And like one example that like we've been getting a lot, as we fundraise is like, is access hard? Because you have a lot of like multi-stage funds investing or like a lot of big pocketed funds. And I think that's a very relevant question for software and AI, where there's a ton of investors, everyone gets the companies, everyone gets excited about the companies that are like, exploding in a good way. For us on the hardware side, it's been the opposite. Like usually we're trying to help someone fill out a round versus fighting for a slot. But it's like, it's so different. Like everyone asks like, well, how do you get access? It's like, well, it's easy. Like the access is always there, but like there are definitely these questions we get that I think come more from the software side that are just like less relevant, at least for now on the deep tech side.
Yeah, we deal with a lot of the same conversations and a lot of the same perspectives on the deep side.
The last topic on that, and we can keep going, is like, I'm sure you've run into this also, but a lot of the, I would almost say like software trained LP base, the first question is like, oh, you're a deep tech investor, you need a giant fund, and are you going to set this up as a 15-year vehicle? And the assumption is it's going to take twice as long and you're going to need tons and tons of capital and have to be able to follow on 4 different times. Mm-hmm. So are you running into that? And, what's your response to that?
Well, one, like, again, I wrote these blog posts, because a lot of times I'll just refer back to them if people ask. So if they ask about the time horizons or the capital intensity, like I'll just be like, well, I did some number crunching. Like you can try it yourself if you want with the same PitchBook data, but like, here's what I found. So I think that helps a little bit. I think it was a harder conversation to have in like year 1 or 2 of the portfolio when we were investing, but like hadn't seen any results yet. Now that we're, 5 years in, I think, especially the first fund, which, we deployed in like 2021 to 23, it's looking pretty good in terms of, one, I haven't looked at the latest benchmarks. I think like the 90th percentile funds are like 1.5x for that era versus like 2x or a little over 2x. And then 2 is like our follow-on rate's been really good. So, out of our 20 companies, actually like 19 in that fund, like 19 have raised some follow-on capital. And then about like 60% of the seed companies went to Series A. Usually it's about 20% average. So I think we just point to and be like, look, like these are not worse numbers than you'd see for a software fund in terms of like the follow-on rates, the multiples. So like, I think now we have like, we're far enough into the fund cycle that we could like point at that. And I think people believe us. It was definitely a harder conversation, like, when we were starting out.
Yeah. Interesting.
Yeah. So one more quick question, and then we're going to probably shift into a little wrap up here. So you're fund 3 now with Humba?
Pretty soon. Yeah.
Pretty soon. So hopefully get your propose there. You think this is a long-term strategy for you here? You think this deep tech thing is, you think this is where the future of venture is going to be and going to play out, and you're digging in deep, and this is where you're sinking your stake?
Yeah. I think it's not the only future of venture, and that I think there's a lot of, potential and value in AI and other areas of software, but it's the area like I'm personally most excited about. Yeah. And then I'm very much like a first principles investor. Like I like thinking about the structure of, a sector or business and like what competitors might do and the game theory of it. And I found that to be really fun on the deep tech side, because a lot of times a lot of these companies have like basically like no modern competition, right? Where you're competing with a lot of like 50, 100, 200-year-old companies that use tech, but not software, or like definitely not autonomy. And so it's like really interesting for me to think about like, well, how would this new product, like how might it fit into the landscape? How might it change the landscape? How might competitors try to react? Is this like, a really meaningfully different technology, or is it just like, slightly better? Like I love thinking about all that stuff, and I really enjoyed that. And for me, like I plan to just like keep investing in like the physical side of the world for the rest of my career.
Awesome. I, by the way, really appreciate you sharing your mindset on all this stuff, because it's super helpful and really aligned with the way Ari and I talk about this as well. So really, it's great to have people like you with that perspective, kind of backing these incredible companies that, we think to a big part are inevitable, right? Like these are companies that are going to change the way we all think, work, live, right? And just appreciate having other good people in that space to help get these companies off the ground. So thank you for doing that. Excuse me. We're going to shift into a little quick wrap up here, which what we like to do when we wrap up is ask just a couple of quick rapid fire questions. Mm-hmm. So we'll shoot them off, just quick answers. No, not looking for deep analysis here. Just love to get your thoughts. So what do you think is one of the most overhyped signals in deep tech from a pitch perspective right now?
I'd say like bigger funds investing early, because I think we see it happen more and more, but a lot of times it's very much like a token check or like a learning check versus a conviction check, especially as those funds get bigger. So I think there's just like very little signal in that. And frankly, like it's been surprising because a lot of funds or a lot of founders we talk to are like, they're excited about it because they're like, oh, this XYZ like multi-billion dollar funds investing, and like they'll do our next round. We actually find that like they're less likely to do the next round.
Yeah, they have no idea what they're getting into.
Invest and, met them and pitch them in a year. So it's been kind of interesting to see. Like, I think it gets a lot of signal because of the brand name, but I think it's actually like a negative signal or non-signal most of the time.
Inverse signal more often than not.
Yes.
Yeah. What do you think? Like one thing that deep tech founders usually underestimate when it comes into hardware manufacturing. Like, do you see a repetitive lesson?
We kind of talked about this earlier, but I think like the kind of that plan for scalability. Honestly, at this point, a lot of people are aware of it. They're just often don't know exactly how to solve it yet. But the fact that like what you build in the lab is very different than we have to commercialize. That's not true in software. And so if you're coming from software, often that's a misconception of like, oh, we got this to work. Now we're ready to print money. And it's like, well, there's a lot of steps between you got it to work and it's actually like manufacturable and commercializable and easy to debug and that kind of stuff.
Cool. So when things start going sideways, as they inevitably do with most portfolio companies, what's one founder behavior that makes you absolutely dig in and like fight like crazy for that founder?
I mean, I think like relentlessness is very admirable, right? Where, like you just try to make things work no matter what. I think also a lot of times like resourcefulness, like we love it when, sometimes you'll see founders where like they'll boast, we're like, oh, this piece of equipment costs like, $1 million. I found someone in like Kentucky selling a used one for $80K. I flew over there, rented a truck. I love stories like that. I just like, it's a hard place to have hustle, but like when you have hustle, I think that's really admirable. Yeah. But honestly, we try to help founders no matter what, but things go sideways all the time.
All right. Last one. Technical founder has a really hard time explaining a complicated thing in simple terms. Red flag or no?
That's a good question. Probably depends on the industry, the timeline and what their role is. What we've seen in software, I think for a while, for example, people basically said for B2B, you need like a lot of charisma and like, be really good at sales. But for B2C, it doesn't matter because people just look at the product, right? Mm-hmm. And so I think there's something to that on the deep tech side in a way where, if you're the technical founder, it probably doesn't matter. Like you're mostly just recruiting engineers anyways versus trying to sell customers. But even if you're the business co-founder, if like, if your audience is very technical, then maybe it's fine. And if your audience is very non-technical, then you need to figure out how to close that gap either by leveling up yourself or hiring someone that takes on sales or something like that.
Got it. All right. Well, I think that's all we got for today. And as David said, thank you so much for being with us.
Yeah, absolute pleasure.
Massive.
Truly enjoyed the conversation. Yeah, truly enjoyed the conversation.
Yeah, great questions. And really enjoyed it as well. Thanks for having me on.
Thanks for tuning in to Massive Signals. If you enjoyed today's conversation, be sure to follow us on Spotify, Apple, or YouTube, and share the episode with someone who cares about the future of deep tech. And subscribe to our Substack at massive.vc to stay in the loop on all of our current investments, thinking, as well as upcoming events like our quarterly deep tech table dinners. Find it all at massive.vc. Until next time, keep listening for the signals that are shaping our future world.